Hello and welcome to Business 360. I'm Arundhati Ramanan and here are the top headlines that we're tracking for you this evening. Israeli airstrikes on Gaza continue as per media reports, killing at least 30 people overnight. Over 5,000 killed in the war so far. Israel claims that at least 203 people are being held as hostages in Gaza. President Biden says that trucks carrying humanitarian aid will enter Gaza via the Egyptian border from Friday. Sensex slips nearly 250 points and Nifty loses 60 points despite an intraday recovery. Crude oil prices ease from two-week highs after United States loosens sanctions on Venezuela. CNBC-TV18 Newsbreak confirmed government dilutes the import restrictions on laptops and tablets. Imports allowed till September 2024 with valid authorization. The curbs will not apply to special economic zones. Government believes current mechanism is WTO compliant after USA, China and South Korea raised the red flag. FMCG major Hindustan Unilever reports a steady second quarter. Profits and revenue grow at least 4%. Margins cross 24%, beating estimates. Volume growth of 2% is marginally below estimates. Nestle India's third quarter earnings largely in line. Profit rose 37% on a yearly basis, aided by a one-time gain of 106 crore rupees. Sources say domestic volume grew at 4%, below CNBC-TV18 estimates. Cement major Ultratech meets estimates in the second quarter. Revenue rises over 15% as power and fuel expenses remain in check. Company says the capacity expansion plan is progressing as per schedule. Global auto major Tesla misses quarterly earnings estimates for the first time in 4 years. On the other hand, Netflix reports strong earnings and adds 9 million new subscribers in 3 months. Netflix also announces price hikes for US, UK and France. Nokia to cut up to 14,000 jobs after third quarter profit plunges nearly 70%. Sales also declined 20%, largely led by a sharp drop in North America. Google to make the Pixel phone in India, the first India-made Pixel to hit the market in 2024, also reveals that 20 lakh YouTube videos were removed in the 3 months between April and June for violating its policies. Our top story continues to be the war between Israel and Hamas. At least 30 people have been killed in Gaza as Israel's airstrikes pounded the region overnight. Since the start of the war, more than 5,000 people have lost their lives. Israel's military is claiming that 203 people, including children, peace activists, elderly people and soldiers, are being held hostage in Gaza. After his visit to Israel, US President Joe Biden said that Egypt has agreed to allow 20 trucks with humanitarian aid to enter into Gaza. The aid is likely to start arriving from Friday. However, Biden warned Hamas against stealing the aid. Meanwhile, British Prime Minister Rishi Sunak arrived in Tel Aviv as a show of solidarity. He said that he stands with Israel against the evil that is terrorism. French President Emmanuel Macron is also expected to visit Israel soon. As leaders from the West continue to express their support to Israel, pro-Palestine protesters in Chicago are calling for an immediate ceasefire in Gaza. Several Jewish protesters also staged demonstrations at the U.S. Capitol Hill. Thousands of people are also rallying in Egypt, Lebanon, Jordan and Yemen in solidarity with Palestinians.
I'm here to express my solidarity with the Israeli people. You have suffered an unspeakable, horrific act of terrorism, and I want you to know that the United Kingdom and I stand with you.
HUL just came out with its quarterly numbers a short while back. Its management is addressing the media. Let's cut across.
Volume shares in more than 75% of our business. On a sustained basis, we have been winning share in large part of our business, which has resulted in a significant corporate share gain in last 2 years. Talking about margins, our gross margins improved 700 DPS year-on-year to 52% and is back to pre-inflationary levels. With competitive intensity remaining high, we have stepped up our A&P investments by about 700 crore year-on-year this quarter. Moving on to performance across the three segments. Home care delivered 3% growth on a very strong base. Beauty and personal care and foods and refreshment both grew 4%. Home care and beauty and personal care, which constitute 75% of our business, grew volumes in mid-single digits, while foods and refreshment saw mid-single digit volume decline due to higher price levels to offset input cost inflation. Margins in all three segments remained healthy, with home care at 19%, beauty and personal care at 27%, and foods and refreshment at 19%. We had a busy quarter with many innovations going into the market. Pond's hydration regime, Indulekha anti-dandruff oil and shampoo, Vaseline's new range of premium moisturizers, and Lakme's range of makeup products were some of the innovations launched in beauty and personal care. In FNR, we have launched artisanal slow churn ice cream made with 100% fresh cream and real fruits. We have extended our Horlicks Plus range with two new variants, Strength Plus for adults and Growth Plus for children. In home care, Vim Pure and Comfort Intense Fabric Conditioner were launched. Moving on to our first half performance, our turnover grew 5% year-on-year, just shy of rupees 30,000 crore. EBITDA margin was up 90 BPS year-on-year to 24.1%. Profit after tax before exceptional item grew 11%, and net profit at rupees 5,189 crore was up 6%. The board of directors have declared an interim dividend of rupees 18 per share for the year ended 31st of March 2024, a 6% year-on-year growth in total payout. Looking ahead, in near term, we remain cautiously optimistic. FMCG demand is likely to continue a gradual recovery with tailwinds from upcoming festival season, sustained buoyancy of services, and government's thrust on capex. At the same time, we need to be watchful of heightened competitive intensity, volatile global commodity prices, as well as impact of monsoon on crop output and reservoir levels. If commodity prices continue to remain where they are, we expect our price growth to be marginally negative. Our focus remains on driving competitive volume growth, stepping up investments behind our brands, and maintaining EBITDA margin in a healthy range. We will continue to manage our business with agility and take actions to ensure long-term 4G growth that is competitive, profitable, responsible, and consistent. With this, I complete my prepared remarks, and now we can take some questions.
Thank you, Ritesh. Sesa, would you like to ask the first question, please?
So basically, I would like to understand, you did mention that the volume recovery will be gradual, but what we have seen in Q2 is the 2% volume growth is the lowest in the last 7 quarters, if I'm not wrong. So could you tell me that when do you actually expect a meaningful recovery in volume? From which quarter onwards?
Yeah, if I can start by framing the response to that, and then maybe Ritesh could help me with some of the details there as well. So first of all, if you disaggregate this 2%, 2.5% actually, by divisions, actually we've grown in mid-single digits on our 75% of our business, which is home and personal care business, which is pretty strong, and it's in line with our strong traditional quarters. Where we've seen a decline is in food and refreshment, where actually prices have gone up, and we're still seeing an impact of inflation on the volumes in those categories. So it's the mix of the two that generates the number that it does. Having said that, we expect the volume recovery to be gradual because our pipelines are adjusting. Consumers are still paying higher prices that we're selling in, and over a period of time, the prices will land on shelves, and we'll start to see the impact of that in consumption. Also, we expect this process to take a few quarters, as we mentioned last time, and therefore we will see a consistent improvement in volume growth. Having said that, we hope when we've gone through this whole cycle of inflation, deflation, and we're more in the steady rate, we should be looking at our mix of 50-50 volume value growth, and we go back to our traditional sort of CAGR of 8-9% that we've had in the last decade. So our intention now is to do the right thing, keep investing for competitive growth behind our brands. As you've noticed, our investment this time is significantly high on our brands. We've actually increased the investment over 65% if you take it over last year's base. So we're doing the right things for the medium to long term, and we're quite certain that given the fundamentals of the business are strong, that the competitive volume growths will come back, and we're very, very focused on that as a one single-minded mission for the entire company end-to-end at this point of time. Ritesh, anything you'd like to add?
No, I think absolutely very clear. And if I just probably add a little bit of context on the past as well, we have seen high inflationary period in the past as well. We had seen in 2008 and 9 for skin cleansing. We saw in laundry 2012 and 13. We saw for tea in 13, 14. In each of these periods, we saw as commodities went up, it impacted volumes. As commodity came down, there's a gradual recovery of volume. That's the exact phase we're going through. If I just quote, for example, FMCG overall price for the market, this quarter, consumers are still paying 3% price inflation, which means all the price cuts that we have taken, they are yet to witness. And once that happens, our view is that volumes will start recovering gradually. And again, remember that we have grown our volumes at 2.5% in this quarter on a base where we had grown our volumes by 4% against market, where on a 2-year basis, market is roughly flat.
Okay. Also, the festive season is underway. So, sorry, just.
Tessa will come back to you. Shilpa?
Okay.
Right. Hi, thank you. Thank you, Prashant. Hi, gentlemen. I'll just take the question from where Sesa ended. In fact, we're just heading into the festive season that's underway right now. What are early indicators of demand telling you right now? And, Ritesh, to take on from your question that you spoke about, the price cuts yet to be reflected. It's been, I think, over a quarter since the price cuts have hit the market. So when do you actually see that translating into volume recovery? Can we say that will be closer to that 50-50 level that, Mr. Rohit was talking about the next fiscal, or can we see some signs of that going towards that later into this in the second half of this fiscal as well?
Yeah, so let me do the pricing question, then we'll hand over to Rohit for festival. So on pricing, as you know, in this quarter, we had roughly flat price growth. And our view going forward, Shilpa, is if commodities remain where they are, we would see, in fact, marginally negative price growth in short term. So that's the pricing outlook given where the commodities are at this point in time. Of course, on a long-term basis, commodities are cyclical, which means what has come down will go up, what's gone up will come down, and it will stabilize. And on a long-term basis, to Rohit's earlier point, we do see FMCG growth roughly 50-50, where we expect half the market growth indeed to come from price and half should come from volume. So that should come. But given where we are at this point in time, that's where the equilibrium is. Second, even in this quarter, Shilpa, in current quarter, we did take price decreases. We did price decrease in soap business. We also took price decreases in our laundry portfolio, because this is where we have given the full impact of all commodity, which has moderated. And typically, we've seen that a quarter later, consumers will start seeing benefit of all of that as the trade pipeline clears up. Market had seen 14% price growth at one point in time. Over last 4 quarters, it has now come to 3% in the current quarter, where we have 0% price growth in the quarter. So I expect a quarter more for that fuller impact to be seen to the consumer. But when the equilibrium will come back, in my view, is more cyclical and more, I would say, a few quarters down the line as we start seeing commodities starting to stabilize. But let me hand over to Rohit on festival.
Yeah, I think just want to state the fact that very important indicator is the competitiveness of the volume growth. And we see in large parts of our business, we're competitive by volume. And, the derivation of that on top line, and eventually we're a big business with mixed of many, many categories. So you see an average number. What we're tracking is, are we investing on our brands competitively, which we are. As I mentioned to you, this quarter, we've increased our A&P by 420 basis points, 65% over last year. And we know we are very, very competitive, and we'd like to stay there. We can start to see that in our competitiveness and volume, which is quite healthy. And now we just have to stay the course and keep doing the right thing for the business to eventually find that stabilized level when the cyclicality of this is over. And it is across different businesses at different parts. Now, coming back to the demand question, what's very encouraging is that we are in a market where we see growth coming back in rural, although they are on a weak base. We also see growth coming back on a positive way in urban. And if you zoom further, we see more growth in urban, in large packs, in more in higher income households. We believe there's also strong government investment in infrastructure, which is finding its way into the economy. And that is creating a tailwind. And we believe secularly, this is a good trend. And as far as the next quarter is concerned, we hope that we are able to leverage the festival and the demand is positive. There, of course, is the unknown and the downside of monsoons. We can't say what impact it'll have. But generally speaking, we are very, very optimistic, and that's how we'd like to operate in this business with optimism, but with one foot in reality.
All right, thank you. I'll come back in a bit with more follow-up questions on that then.
So HUL management, they're saying they're quite optimistic about the festive season. But let's go across to Mangalam Malu, who joins us now to decode HUL's numbers. Mangalam, a steady quarter there for the company?
It is a steady quarter given the environment for Hindustan Unilever this time around. But what really stands out in these numbers is it's a very strong operational performance. The gross margins of the company this quarter have expanded by 700 basis points. And not just that, the company has plowed them back into ad spends as well. Just for context, earlier they would spend 7% of their sales on ads. Now that's increased to 11%. Despite that, the EBITDA has come in much higher than expectations at nearly 2394 crores as against street expectations, rather 2694 crores as against street expectations of 2600 odd crores itself, 3600 odd crores itself. If you just take a look at the net profit, that too has beat street expectations by a good 100 odd crores. And what's good this time around is that we've seen gross margin expansion, ad spends have increased. Volume growth, however, has come in at just 2% versus expectations of 3 to 4%. And management sees gradual recovery and continues to see high competitive intensity. What happens to the stock? The stock, remember, has been an underperformer, is still 10% away from its 52-week high, so should open in the green purely on account of this strong operational performance.
So we'll have to wait and see where HUL opens tomorrow. But thank you so much for those details, Mangalam. But staying with earnings, Nestle India's third quarter earnings were largely in line with expectations. The company's net profit rose 37%, led by a one-time gain of 106 crore rupees. Sources have told CNBC-TV18 that the company's domestic volume grew at 4%, which is below CNBC-TV18's estimates. Nestle India's quarterly revenue crossed the 5,000 crore rupee mark for the first time. Cement giant Ultratech's second quarter numbers were in line with street expectations. The company's net profit rose nearly 69%, while revenue grew more than 15% annually. Power and fuel expenses were up more than 2% in the second quarter, while net debt widened to nearly 5,000 crore rupees sequentially. PVR Inox reported its best ever quarter in July to September on account of strong box office collections of Gadar 2 and Jawan. The multiplex chain's net profit stood at 166 crore rupees as against a loss of 82 crore rupees in the previous quarter, while revenue came in at nearly 2,000 crore rupees. Average ticket price jumped by more than 25%, while footfalls rose over 60%. On that note, it is time for us to head into a short break. But coming up next, government dilutes the import restrictions on laptops and tablets. More details when we come back. Stay tuned. Welcome back. You're still with us on Business 360. CNBC-TV18 News Break confirmed the government has diluted the import restrictions on laptops and tablets. Under the revised norms, importers will need to acquire import authorization. The authorization can be acquired by submitting information on the value and quantity of their imports. Now, the government says the mechanism is compliant with the World Trade Organization's rules. This after US, China and South Korea raised the red flag at the WTO.
The relaxations are more in the nature of clarifications, which have been issued based on detailed consultation with industry and various other stakeholders. We are trying to ensure that there is no shortage or no artificially created scarcity of essential computers and other equipment, which are very widely used in the country. Many people use them. Offices, students, a whole host of them use them. Even households use them. So we have to ensure that there is adequate availability of this equipment. Eventually, of course, we will be looking to see that more of it is manufactured within the country.
Just one follow-up question, sir. The import authorization valid till September 30th, 2024. Are we to assume there will be perhaps additional restrictions post that period?
Right now, we will study the data and we'll figure out what needs to be done. So we can't make any assumptions today.
And would this mechanism, sir, be WTO compliant? Because that was one concern.
We anticipate that, we believe that this entire mechanism is WTO compliant, and we have not violated any element of our commitments under WTO.
General insurers will soon provide motor cover to employees travelling in employers' vehicle. This after a move made by the Madras High Court. Yash Jain is here with more details. Yash, take us through the details.
Well, Arundhati, a very crucial move and a much-needed move from the insurance regulator. This, as you mentioned, comes after the Madras High Court order and the observation from that particular court. As per the directions from the insurance regulator, all general insurance companies will now have to provide a mandatory insurance covers for all passengers sitting in the car belonging to the employer providing that fleet or the transportation service. As of now, only the driver of the car was insured under the motor insurance policy. But now, as per mandatory directions from the regulator, all passengers of the car will have to be insured under this particular motor insurance policy. Typically, a motor insurance policy has three elements. The third party, own damage and personal accident. Personal accident is something which covers the owner of the car, of course. Now, under the third party cover itself, there will be a mandatory element which covers all the passengers of that particular vehicle. Now, of course, this is positive for all policy holders and people who take employers' transportation to get to home or to get to work. But, of course, it's negative as far as these general insurance companies are concerned. And that is because the insurance regulator has said that this additional cover for all the passengers of the car will have to be given at zero cost, which means no additional premium. New India Assurance holds about 11% market share in the motor insurance business. ICICI Lombard holds about 10% market share, negative for both those companies.
All right, Yash, many thanks for those details. And with that, it is a wrap on this edition of Business 360. Many thanks for watching, but stay tuned to CNBC TV18. The news continues on the other side.